Good morning, my name is Yasha and I help young men invest in the stock market. So today we are going to analyze this quite famous pizzeria called Domino's Pizza Incorporated with the stock ticker DPZ. If you are wondering whether you should buy or sell Domino's Pizza stock, or if you are wondering how good this stock is, then this is the perfect video for you. Now, as always, we are going to analyze it using this little Canva presentation that I have right now here. So let's begin, okay? First of all, why should you even listen to me? As you know, my name is Yasha and I help young men invest in the stock market. And when you have more trust for me, the first link in the description will take you to my one-to-one stock market coaching. So see you on the other side, okay? Now let's begin with the actual analysis. So this is going to be very simple, beginner friendly, straightforward. You will learn a lot. So grab a piece of paper, grab a pen and write some notes down. Now if you are a complete beginner, okay, you should generally care about the following 6 things. You should care about chart, profit, debt, money on the bank account, value and price. Now let's go straight into it. So here you have some quick facts about Domino's. It's a restaurant that was founded in 1960 and it's a famous pizzeria all over the world. I think we also here in Spain, we have even all-you-can-eat Domino's, so yeah, quite famous. Now here is the first thing that you should pay attention to, okay? Domino's was founded in 1960 and generally whenever you analyze stocks or whenever you want to invest in the stock market, you should invest in companies that are a bit older, okay? Preferably, they should be established before 1950 or 1960 because the older the company is, the higher it has the chances that it will survive one, let's say, stock market crash, okay? Because let's take a look, for example, at Domino's. So Domino's is since 1960 around, so they survived quite a few stock market crashes, okay? They survived the Black Friday, they survived the dot-com bubble, they survived 2008 stock market crash, they survived the coronavirus, you know what I mean? So they survived at least 4 crises, whereas if you have one startup that was founded maybe 2 years ago, for them we don't know if they will survive another crisis because they haven't been tested yet, you know what I mean? But the older the company is, the more they were tested, the more trust we have in them because we know that if they survived so far, then there is the higher chance that they will also survive in the future, okay? So the older the company is, the better it is. Preferably you want to invest in companies before 1950 or 1960s, okay? Now let's come to the chart. And for chart, we also have an instruction that it has to grow for all 10 years. Now, what exactly does that mean? That means that I will draw a little exponential line here, kinda like that. And we are going to compare the actual stock price chart, which is this orange line here, with that black line, and preferably they should follow each other, okay? Because whenever we invest in stocks, we want to invest in growing stocks, in profitable businesses, so that they can bring us money in the long term, okay? It's that simple. So now, does this company grow according to the chart? Yes, it does, especially here. Take a look here. Until 2022, the company was growing quite well, and then Ukrainian war happened probably, and then the stock went out a bit, but then it started to grow again. So yeah, generally the chart is growing, the business is profitable according to the stock price, so we are good to go here, okay? It's very simple, just think logically, compare, just ask yourself, yeah, is the chart growing or not? It's that simple, okay? Now let's come to the profit, and for profit we also have an instruction, it has to be in plus and it has to grow as well through the all years. Now here is the very same story, man, okay? We will draw a little exponential line, kinda like that. And now we are going to again compare the profit with this black line that grows exponentially, okay? And preferably they should again follow each other, okay? Does the profit follow? Yes, it does. You can see it goes quite well. Obviously here it's a bit down, but then up again. So yeah, the profit is growing, it's growing exponentially. This is what we want to see, okay? Domino's is profitable. Here again, use your logic, use your brain. You are a smart young man. Now, that's it, okay? We come to the debt now, and for the debt, we have an instruction that it has to be low, and preferably it should decrease through the years as well. Now, here we have exactly the opposite. Here we have a growing debt, which is generally bad for businesses, okay? Because if you think about yourself, the more debt you have, the more stressful you are, the harder you sleep at night, the more you overthink, and the higher the chances are that you will do some stupid decision in order to repay that debt back, okay? Because you are panicking a bit. With the companies, it's exactly the same. The more debt they have, the higher the chances they have that the management will do some stupid decisions, the more chances they have that they are a bit like stressful about it, you know. So higher debt usually creates a stressful environment, which is why we want to see it decrease through the years, okay? Now here it's exactly the opposite, so we don't like the debt at all, okay? And now we come to the money, and here we literally measure the money that they have on their bank account, okay, as you can see here. And preferably they should have more money than the costs. Now you might be confused, what money is this exactly? This is literally the money that they have on the bank account, just like you, okay? You have maybe $200, $300, $400 on your bank account. Here it's exactly the same, okay? And preferably they should have more money than they have the costs, okay? Now, how do we know that? Look at the bank account balance. You are a smart man. They have plus $500 million on their bank account. Now, this is a good news. Why is that a good news? Because if something unexpected happens, you know, let's say that one pizzeria was robbed, okay? One Domino's was robbed, because it probably happens in America, okay? So if something like that happens, it's a bit unexpected, okay? So they have more money to cover that unexpected event, okay? They can say, okay, Domino's was robbed, our customers left us, how are we going to cover that loss that happened because of the robbery? We have $500 million on our bank account, let's cover it with that, okay? That's why positive bank account balance is important, okay? Positive bank account balance basically means that you have money on your bank account. It's that simple, okay? Now, the same is with you, okay? For example, if you have $500 on your bank account, you can go without any worries to that date that you want to go, you know, and then maybe fuck that girl. Because you know that you have the money, you know, you can cover fucking Domino's pizza if you go on a date there. So it's the very same story, okay? You know what I mean. The more money they have, the better. That's a rule of thumb. Now we come to the valuation, and obviously when we invest in stocks, we want to invest in undervalued stocks. Now, how do we measure valuation? By two things. First thing is P/E ratio, and the second one is intrinsic value, okay? Now, as a complete beginner, this might sound a bit complicated for you, but don't worry, just follow the script here and you will be fine, okay? P/E ratio should always be lower than 15, and intrinsic value should always be higher than the current stock price. Now, what is exactly P/E ratio? P/E ratio, just quickly explained, is something that we measure for the company and then compare it with the competitors and the market, okay? It basically tells you price to earnings, and we measure it for valuation, okay? Now, stock market on average has P/E ratio of 15. That's why we have to have P/E ratio lower than 15, because we want to invest in stocks that are undervalued in comparison to the market, okay? Now, Domino's P/E ratio is 26, which is by around 10, higher than 15 as we want to see. So in terms of P/E ratio, Domino's is overvalued, okay? And now we come to the intrinsic value, and this is a very simple concept, okay? Intrinsic value basically tells you what price should Domino's have at this exact moment in order for it to be a fair price. You know what I mean? So the fair price of Domino's should be $419, okay? This is the price that Domino's should have, but they actually have $409, which means that the actual stock price is by $10 lower than it should have been. You know what I mean? So that's a good sign for us, because intrinsic value should be higher than the price according to our instruction right now here, in order for stock to be undervalued, okay? And since here intrinsic value is higher than the price by $10, that means that the stock is by $10 undervalued. You know what I mean? So that's a good sign. Now we have one overvalued measurement and one undervalued measurement. So is the Domino's overvalued or undervalued? We want to be as harsh as possible when we analyze stocks, okay? That's why we will measure Domino's as overvalued stock. And now we come to the stock price, and instruction tells us that it has to be lower than 150 euros. That's for me, I'm from Europe. You are from America, so for you it's $150. Same concept. Now the current stock price of Domino's is $409, which is around 4 times, or let's say 3 times higher than it should have been, okay? So the price is overpriced. We don't want to see that. Now $150 is kinda the limit that I set for myself, because whenever you are a young man, you are on a tight budget, okay? So if it doesn't matter if you have like $400 or $500 in your bank account, it doesn't make sense that you invest like the majority of that money into just one single stock, which is Domino's Pizza. You want to invest in more stocks, you know, so that you can diversify your portfolio a bit. That's why we want to have stocks that are below 150, because they are cheap and we have higher chance that we will get rich by them, okay? Because we don't want to spend money, we want to make money. It's that simple. And now we come to the final evaluation, where we are just going to summarize everything that we found out about Domino's so far, okay? Does the chart grow? Yes, it does. It even grows exponentially, which is what we want to see. If you don't believe me, watch the whole video again. Does the profit grow exponentially? Yes, it does. Does the debt decrease through the years? No, it doesn't. Do they have money on the bank account? Yes, they do. They have around 500 million. Is the stock of Domino's undervalued? No, it isn't, because P/E ratio is above the average of stock market, but intrinsic value is kinda not that higher than the current stock price, so no, it's not undervalued. Now, is the stock price below $150? No, it's not. It's around 400. Now, should you buy or sell? In my opinion, you should sell Domino's Pizza because of the following reasons, okay? First of all, it is true that the business is profitable. Like Domino's Pizza is an amazing company actually, until you see what they're doing with their debt, okay? Now I will show you here a detailed analysis, and you can see that here are some alarming things, okay? First of all, it's retained earnings. Retained earnings tell us how much money does company invest back instead of paying it to the dividends as dividends to the shareholders, okay? Now, if retained earnings are negative, that means that the company is giving more money to the shareholders than they have money coming in, okay? This is completely unsustainable. As soon as you see retained earnings in minus, that means that the company is spending more money than they have. That's why total equity, which measures the whole money coming inside the company, is also negative. If total equity is negative, that means they have more money going out of the company rather than coming inside, okay? Which is again completely unsustainable. We don't want to see that, okay? Same with return on equity. If it is in minus, that means that they actually make losses even though the net income is positive. Another thing is debt to equity ratio. If it's negative, that simply means they have more money going out of the business rather than coming inside, okay? So no matter even if Domino's Pizza is profitable, they have amazing growing chart, they have amazing profits that are growing through the years. Even though they have all of that, their cash flow, so the cash coming inside and outside the business, is horrible. I don't want to invest in that company really, because they are completely unsustainable. If it goes like that through even further, they might go broke, honestly, in my opinion. So in my opinion, you should not buy Domino's Pizza. If you have the stock, sell it if it's profitable. That's what I would do. And yeah. Now, if you want to know more about stock market investing, click the first link in the description. When you trust me a bit more, click subscribe, join me on this amazing journey to become rich with stock market. Do the hard work and see you on top of the world.